All right, so we have the market trading down into a very, very deep discount. If you look at the range low here, why am I not picking this one here? Because this move started there. Okay, that's what I'm looking at, this move. These are relatively equal lows, so I'm just going to move over to the most recent swing low. Why is this a swing low? We have a candle to the left of it that has a higher low than this one, and a candle to the right of it has a higher low than that one. So that's swing low, that one here to here, that's my daily dealing range. Okay, the market has recently retraced back down in about 50% equilibrium of that price move. Okay, so that's what we're annotating here, about halfway is what really essentially what's being shown. And also, because of that, the market is likely to create a little bit of a retracement. So because this daily chart has retraced down into about half of the move from that low to that high, so we basically went back to equilibrium, or roughly a short-term discount. Because of that, there's a likelihood that the daily bias is going to be bullish on this day here and this here. Now, we're going to look at this candle because midpoint of this candle, that right there is the mean threshold. Mean threshold is the half point or median of a order block. That right there is rooted on this up close candle. Why am I using that up close candle? Because from this high down into the 50% retracement of that low and high, where the market goes back to equilibrium or short-term discount, that means the bias has a likelihood. Now, folks, listen. You want to be taught about bias? I'm teaching it. Listen. You went down to equilibrium or short-term discount. The next day, we can expect it to go higher. So what do we do with that information? If it's likely to go higher the next day or the day after that, what happens if the next day is down or if it doesn't move? Okay, you go into the next day expecting it to go higher. This, it just so happens that what I outlined on Monday panned out. But that's what I'm referring to every single week. I'm outlining something. This is your premium array. That means it's going to draw up into that. It could be this candle's low because it's the order block, bearish order block. Why should I be concerned about this candle? Because in this move here, right before this displacement on the downside, this was the last up close candle. So you have several targets here. You have the candle low, the open, the mean threshold, halfway order block, and you have the high. The high is the less likely. The easiest is one down here. So on this candle here, when we expect it to go higher, we can see it trade up into that candle's low. We can see it trade up into that candle's body. We can see it trade up into that candle's mean threshold. You're looking for the lowest hanging fruit. Which one's the easiest for you? Now, blending that with the idea of purge and revert. We went down. We took out short-term low, sell side liquidity. See that? Right below here. So we purged sell stops, and it's going to revert back to the high in the last 3 days. So day 1, 2, 3, that's this day here. So this candle's high, it can draw back into. So we have, yes, this order block low, but then we have this idea here where the move dropping down, that high is going to have what resting above it? Buy stops. Why would there be buy stops there? Because traders that are short, they're going to trail their stop loss right there.